Well, hello and welcome to this evening's webinar, AAII and Better Investing Year-End Tax Planning. Thank you so much for joining us. We are so happy to have you all here. My name is Jenna Brashear and I will be your host for tonight. A few things to go over before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And we have two wonderful speakers tonight, Charles Roadblatt from AAII and Christy Powell from Falcon Financial of Oklahoma, LLC. I want to thank both of them for being here with us this evening. And then be sure to keep an eye on the chat throughout the webinar as I'll be sharing helpful resources and key insights throughout. And if you have any questions for our speakers during the presentation, please submit them using the question section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And then once our presentation concludes, I'll select a few for Charles and Christy to answer. And then if your question isn't selected during the broadcast, feel free to email us at members@aaii.com. And if you experience any issues with the audio or video of the webinar, please consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be sent to all who attended today. And then the recording will also be accessible at aaii.com/webinars and our YouTube channel. In this presentation, Christy and Charles will cover several topics, including understanding the major OBBBA-driven tax changes for 2025 and 2026, learning actionable year-end strategies for 2025 and key steps to prepare for 2026, discovering how the updated rules impact Roth conversions, and exploring why QCDs remain a powerful tax-efficient giving strategy. And then we love that our webinars are always interactive. So after our presentation, we'll host a live Q&A, including two special promos from AAII and Better Investing. So please make sure to stay for the entire broadcast. And with that, I'd like to hand over the presentation to Charles to kick us off.
Thanks, Jenna. Happy Thanksgiving, everyone. We appreciate you joining us today. I'm going to start off by talking about the 2026 and 2025 taxes here. And really the changes that are going to be affecting your taxes. Now, we did have a tiny law passed earlier this year, the One Big Beautiful Bill Act, or as everyone likes to abbreviate, the OBBBA. Try saying that 3 times fast. And this actually either extended or changed many provisions in the tax code, including the 2018 Tax Cuts and Jobs Act, which is also known as TCJA. TCJA is a lot easier to say than OBBBA. But without the One Big Beautiful Bill Act's passage, many of the TCJA's provisions would have expired, particularly many of its tax cuts, many of its reductions. So it did make many sections of the TCJA permanent. It extended some, revised some. We'll get into that. But what the other thing the One Big Beautiful Bill Act did was also introduce many new tax breaks, some of which are permanent and some are temporary. And those temporary ones either expire in 2028 or in 2029. Of course, you didn't expect Congress to make things simple, did you? But I will go through all of these in the coming slides. So let's start. A lot of the provisions in the One Big Beautiful Bill Act have actually have modified adjusted gross income limitations or thresholds. MAGI, for the purpose of the One Big Beautiful Bill Act, and I'm going to say the full name because it's a lot easier than trying to say OBBBA, and I'm sure I will stumble if I keep trying to say that. But for this purposes, MAGI actually starts with your adjusted gross income, AGI. So again, a lot of abbreviations here. So AGI, adjusted gross income, you see that a lot in the tax code. It's shown on your tax return. There's actually a line on your 1040 that does say adjusted gross income. And it includes things like the standard deduction, it includes your income in it, but it also adds back income excluded under the foreign earned income exclusion and an income earned while residing in U.S. territories. And most of you don't have to worry about that but it is part of the tax rules, which is why I'm explaining it. Now, this slide is small and there's a lot of information on it, so don't worry about trying to read it. I'm going to go through a lot of the changes you see in here, but the two things I will point out, if you look at the two right-hand columns, you'll see there's a lot of phase outs and there's a lot of effective periods. Some are permanent. Again, some go through 2028, some go through 2025, and some don't start till 2026. So again, Congress, when given the chance to make something simple, will always go for the thing that is more complex. It's just how they are. So let's start with one of the simple things. There's a bigger increase in the lower tax bracket. So one thing the One Big Beautiful Bill Act did was increase the bottom three tax brackets. Those are the 10% to 12% and the 22% tax brackets. As you can see, when you get to that fourth tax bracket, the 24% tax bracket, you actually have an increase that's more in line with inflation at 2.3%. And when we look across the overall changes in the tax numbers 2026 compared to 2025, what we see on average is a 2.3, 2.2% increase. Now those numbers vary depending on whether it's a straight increase in inflation, whether those numbers, it actually increases in $500 increments, or whether it increases in $1,000 increments. But on average, we are seeing the inflation adjustments in the 2026 numbers being about 2.2, 2.3%. Now, the key thing about this is to realize that the extra 4% adjustment in your 10%, your 12%, and your 22% brackets means more of your income is being taxed at lower tax brackets. The tax code is marginal. So what that means is that every one of your taxes gets taxed at a certain rate. So nobody's getting taxed the highest tax rate for all their income. It's graduated. So the bigger the lower tax brackets are, the lower your effective tax rate is. And your effective tax rate is basically a weighted tax rate, which considers at what threshold does each of your income get taxed. So it's essentially a tax break for everybody who's in a higher tax bracket. Now, the other thing about we talk about MAGI, modified adjusted gross income, is that it actually includes all your earned wages, so it includes all your earned wages plus your realized capital gains. So the capital gains you realize in a taxable account from selling stocks or bonds at a profit. It also includes dividends, it includes interest, and your taxable retirement distributions, such as your required minimum distributions, your RMDs. Again, when you get to the tax code, there's a lot of abbreviations. Now, MAGI, for the purpose of income phase-outs, adds back certain foreign income and your income earned while residing in most U.S. territories. Now, I will point out that Medicare uses a different type of MAGI for to determine what premiums you will pay. It actually includes your non-taxable income. And when you get to Social Security, it uses combined income, which is a different form of adjusted income. So there's different versions of modified adjusted gross income, but for our purposes, we're just going to stick to it, adding back the foreign income and the income you earn by residing in certain U.S. territories. And now let's go to the standard deduction, because this is one of the things that was changed in the One Big Beautiful Bill Act. So it was initially raised by the Tax Cuts and Jobs Act, and had the One Big Beautiful Bill not been passed, it would have reset to lower levels. Instead, what the One Big Beautiful Bill Act did was not only made the higher standard deduction permanent, it also raised it. So we basically had a double inflation adjustment made this year. So in layman's terms, what that means is that the standard deduction for married joint filers was originally $30,000 for 2025. As you can see on the slide, it's now $31,500. So the 90% of us that take the standard deduction, we just got a larger standard deduction, which means $1,500 of our taxable income is now no longer taxed. So it's a benefit to us for the married joint filers. You also see that was increased for single filers, for the married but separate filers, and for the head of households. So, and the nice thing is about this is that the higher the standard deduction is, the easier taxes become because it becomes harder to itemize. And itemizing can save you money in certain situations, but it also adds a level of complexity. And again, as I pointed out, the most recent tax year we have this data for, which is 2022, 90% of taxpayers took the standard deduction. So it's a benefit to most of you watching today. The other thing, though, One Big Beautiful Bill Act did on the deduction side is added what's known as the enhanced deduction for seniors. And this is in addition to the standard deduction. So if you reach the age of 65 this year, you get to claim your standard deduction and you get to claim your enhanced deduction as well. There's a couple keys to this. First of all, you must be 65 by the end of 2025. So if you turn 65 on January 1, 2026, sorry, you're out of luck this year. You have to be 65 by the end of this year. Now, if you're married filing joint returns, you both must be age 65 by December 31st to claim the senior deduction. Otherwise, it's $6,000 for the person who's age 65 now, but not the second person in the couple. The other nice thing about this is if you itemize, you can also take the standard, you can actually take the enhanced deduction for seniors. So you can't take the standard deduction, but you can take the enhanced deduction for seniors. So it works regardless if you're itemized or if you're taking the standard deduction. So now if you're sitting back going, well, this is really great. Well, if you're married and filing separate returns, you can't take the enhanced deduction for seniors. It is the way the law is written. It is specifically written that you must either be filing a joint return or filing as a single person. If you're married filing separate returns, you're out of luck. And if you're angry about that, blame your Congress, blame your representative, blame your senator, because they clearly did not read the bill closely. And there's various examples in the tax law where it's pretty clear they didn't really think this through. They just pushed it through. And it is a big bill. But I do want to point that out to you. Now, there are phase outs going back to this modified adjusted income. It starts to phase out if you're married filing a joint return at $150,000. And if you're single, it's at $75,000. Now, you may notice that the 2025 numbers and the 2026 numbers are exactly the same. This enhanced deduction is not indexed for inflation. It's going to stay at the same levels, both the deduction and the phase outs, until 2028. And at the end of 2028, it expires unless it's extended by Congress and the president at that time. Another new deduction they put into the One Big Beautiful Bill Act is a charitable deduction for cash donations. So if you take the standard deduction, as you know, you can't write off your charitable deductions. But some of you might remember during the COVID pandemic, there were a couple of years where we could take the standard deduction and take a charitable deduction as well. That's back and it's bigger. So starting in 2026, if you're married filing a joint return, you can deduct up to $2,000 of cash donations. They must be cash donations. So if you donate a nice piece of furniture, you donate some artwork, you donate some appreciated stock to a charity, and you take the standard deduction, you can't take that write-off. But if you give cash to a charity, you can take that write-off if you're claiming the standard deduction. Now, according to IRS rules, you must have a receipt, a bank statement, or a credit card statement. But you really only have to show them if you're audited. So realize by the rules, you have to have it documented. And if you get audited, you have to show that you did it. But the reality is, for instance, early this year, I saw some Boy Scouts selling some popcorn. I really didn't want the popcorn, but as a former Boy Scout, I like to support them, so I gave them a cash donation. I can't take it this year because it's zero, but starting next year, it goes into effect. And this time, unlike during the COVID pandemic, it's permanent until changed by law. So this is a nice little break for those of us who take the standard deduction and like to be charitable minded. Now, I will point out, and Christy's going to talk about the qualified charitable distribution. If you have a choice, you're a senior, you have a choice between taking the QCD, the qualified charitable donation, and taking this cash donation, you're better off using your qualified charitable distribution. The reason why is your qualified charitable distribution reduces your income dollar for dollar versus your deduction reduces your taxable income. So it's always more advantage to your advantage to use the QCD if you're able to. Now, if you itemize, there's a different change for you. Starting this year, starting this year, you actually have a new floor. And it's 0.5%. Sorry, it goes into effect in 2026. I just said this year. It actually goes into effect 2026. So if you itemize, take a deep breath. This year you're fine, but next year there's a 0.5% base floor on your contributions. And so I know many of you are going, what is that? So what you understand it is that donations below 0.5% of your contribution base, which is typically your adjusted gross income, your AAII, typically you can no longer be deducted. So right now in 2025, say you make charitable donations of $5,000. Right now, all $5,000 worth of those donations, whether it's cash, whether it's furniture, whether it's artwork, whether it's something else, that whole $5,000 is deductible. But starting next year, you can't take out the whole $5,000. So let me give you an example. Say you're a taxpayer with $200,000 of adjusted gross income. You would receive no deduction for the first $1,000 of charitable donations. And so that $1,000 is 0.5% of $200,000. Now you don't lose that $1,000 of donations. You can actually carry that forward to a future year to deduct it. But what this essentially, and you can carry it forward for 5 years. So what this essentially does, again, is make the qualified charitable distributions, if you're eligible for them, more attractive to those who are itemized. And to take a QCD, you do have to be age 70. And again, Christy will explain the QCD in more detail. This rule 2 is also permanent. So the basically new tax law gave a little bit on charitable donations for those who take the standard deduction, but it took away a little bit from those who itemize. But it did do something for those who itemize. It maintained the SALT deduction, the state and local deduction. And so the SALT deduction, state and local tax, was scheduled to expire at the end of this year because it was included in the Tax Cuts and Jobs Act, but it was set to expire at the end of this year because they were worried about the impact they had on the budget. And one of the reasons we did have a standoff earlier this year in Congress was over the SALT deduction. And the compromise was not only was it maintained, but it was greatly increased. So instead of being $10,000 this year, it's now $40,000. So those who itemize and take the state and local tax deduction are now, who might not have before because it was at $10,000, but now are possibly able to itemize because it's higher. This works to your advantage. And the other thing they did is they added an increase in it. So every year through 2029, it's going to increase by 1%. So if you look at this chart, you see it's at 40,000 for 2025, no longer 10,000, but 40,000. And in 2026, it goes to 40,400. Now you must itemize and claim it. The other thing is, if you're subject to those phase outs, and you can see where the numbers are, they're actually pretty high, and those two increase every year by 1%. So when you start factoring in inflation, if your salary goes up by more than, or your taxable income goes up by more than 1% per year, your phase out will actually come sooner for you. You'll lose some of it, but the minimum deduction is $10,000. So you don't lose your full deduction, it just drops to $10,000. So again, Congress is making things a little complicated here, but the big news is if you're eligible to take the state and local tax, which is can actually be a real positive if you live in a higher tax state like we do here in Illinois, or perhaps some of you will say live in California or New York, this could potentially help you. Now, this again is still a temporary provision. It was just extended from instead of expiring at the end of 2025, it now expires at the end of 2029. They added a new tax break this year, the auto loan interest deduction. Now, this only applies to vehicles whose final assembly occurred in the U.S., and the tax law specifically says this. Now, how do you know if a final assembly occurred in the U.S. when you have cars being made here, you have cars being made in Europe, you have cars going back and forth between the borders of Canada and Mexico and the U.S.? Well, my suggestion to you is to ask the dealer to figure out which cars actually qualify for this. Now, the nice thing about this deduction is it can be claimed if you take the standard deduction or if you itemize. But if you lease, you're out of luck. This only applies to loans on new car loans. It does not apply to leases. Now you'll notice the limit on this is $10,000 of interest. That's a lot of interest. And I did the math. So it basically equates, so the current average loan for an automobile right now is 7%. So if you do the math, it basically equates to you having two loans at 7% on two cars priced at $70,000. So that's quite a lot. It's a pretty huge car payment. So they really set this pretty high. And there is a phase out on this. It starts phasing out when you have a married joint income of $200,000, or if you're single, it phases out at $100,000. And again, it can be taken with a standard deduction, or if you're single, it's not indexed to inflation and it expires at the end of 2008. They also changed the gift and estate taxes. They actually made changes to the estate and gift tax exemptions as well. So the One Big Beautiful Bill Act not only made the higher estate tax permanent, but also increased they actually increased the exemption. So starting next year, it'll actually increase to $15 million. So right now, it's at $13.99 million. So it'll increase to $15 million per person. One thing that Tax Cut and Jobs Act did was made the deduction portable, meaning the first spouse who passes, they're able to pass on their exemption to the surviving spouse. So basically, it combines for the surviving spouse, it doubles. So this year, it's $27.98 million, and next year it will rise to $30 million. So for many families, it really allows many families to pass on a great deal of wealth while incurring the gift tax. The lifetime gift exemption will also be set at $15 million next year, and they had been set to return to pre-Tax Cuts and Job Act, pre-TCJA Tax Cuts and Job Act levels after the end of the year. So it was reset. With the gift tax, that's adjusted for inflation, but it will stay at $19,000 in 2026, and it's at $19,000 for this year, and the same if you're married filing joint. So the gift tax is indexed to inflation, but it's increasing at $1,000 at $1,000 intervals. So what you see here is actually staying the same because it hasn't hit that a big enough threshold to actually change. And if you hit the exemption for the state tax, the 40% tax rate does apply. Now let's talk about the alternative minimum tax. This comes into play when larger deductions are taken and when you have a lot of deductions. And so one thing the One Big Beautiful Bill Act did was made the larger exemption amounts mandated by the Tax Cuts and Jobs Act permanent. They had been set to expire and roll back to pre-TCJA levels at the end of this year. So it maintained those. But on the other hand, it lowered the phase-out levels. So as you can see here in 2026, instead of rising up in inflation, they dropped. So if you're filing a married joint return, it was set at approximately $1.25 million. And in 2026, it drops to $1 million. And you can see on the slide where it also drops for singles and people who are married filing separate returns. So this could potentially cause more people to actually face the alternative minimum tax before. Because what basically causes, once you reach your phase-out level, the phase-out level also rises from 25 to 50%, so it accelerates quicker. So this could expose more people to the AMT. And again, the AMT occurs when you tend to have a lot of large deductions. So if the alternative minimum tax is something you're subjected to, realize you could be hitting it faster starting it next year. And again, if you're upset, blame Congress. I'm just the messenger here. We also have a new account called Trump Accounts for Minors. Starting this year, the government's seeding $1,000 to a Trump account for every person, every U.S. citizen born between 2025 and 2028. Now, starting sometime next year, we don't have an exact date, up to $5,000 can actually be contributed to those accounts. So if you have a child, you have a grandchild that was born this year, or maybe they're born next year, or 2027 or 2028, you can contribute up to $5,000 up to the Trump account starting in 2026. Now, now keep in mind, there's a bunch of caveats here. So while the idea behind the Trump account is good, there are restrictions and caveats. So starting with that $5,000 you contribute, it's not tax deductible. Once you contribute it, any earnings withdrawn or anything is actually can be taxed at ordinary income. That's ordinary income. And not only that, there's also restrictions on when the money can be withdrawn. There's restrictions starting at age 18, and there's more restrictions going on. Now, if they take a withdrawal, there's penalties if they don't spend it on certain things. And you're talking about things like starting a business, college education. You want to really make sure you read through the rules, and particularly if a minor that has a Trump account, make sure you fully understand the rules applying to this. But the other thing I'll tell you, if you have a child or a grandchild born this year, next year, or through 2028, you want to consider if other avenues are given are more advantageous. Perhaps you might find it better to donate to a 529 plan. You may find it more advantageous to give them a gift below the gift tax limits. The idea behind Trump accounts is good. The idea of seeding an account when someone's born and letting that money grow is a good idea. But because of restrictions on how the money can be spent, again, you want to actually consider your options to decide what is the best option for you as a gifter and what is the best method to give it for the young child. Now, let's talk about some tax planning considerations here. There's a lot here, and I obviously gave you a lot to think about here. One of the things I'll tell you, if you've been bundling donations to itemize, consider donating them this year, because next year that floor comes on. So this year, you're able to deduct all your itemized deductions. And the reason why some people have been putting off making donations and trying to bundle them is because of the higher standard deduction. By waiting to do it all in 1 year, you actually are able to claim you're actually able to itemize and then thereby claim a larger tax break. So if you've been waiting to do that, consider doing it this year, not next year. If you make cash donations and you take the standard deduction, consider whether or not it might make more sense to donate in January versus now. Now, I do realize there's food banks, a lot of people are in need, so you do want to consider the needs of the charity you're giving to. And in fact, anytime you're taking taxes into consideration, if you're being charitable, you do want to take in the needs of the charity you're going to, and when do they need those resources. But if they can wait about 6 weeks from now and you itemize it, make more sense to actually do it on January 1. Now, that new enhanced senior deduction creates opportunities for those who are 65 or plus, particularly when it comes to making Roth conversions. And Chris will explain the Roth conversions momentarily. But also, as I showed you, many of the provisions in a One Big Beautiful Bill Act are set to expire after 2028 or after 2029. We're going to have a new president 2020, starting 2029. President Trump will be limited by term limits. Who that will be and what changes they'll make to the tax code is anybody's guess. So we can always only make tax plans based on what we know the tax law to be now, not what we think it might be in the future. Now, I went over a lot in a short period of time. Don't worry, there's not going to be a quiz at the end, but in our tax guide, which will be on our site next week, for AI members know this, and for Better Investing members, I will tell you every year we publish a comprehensive tax guide where we actually go through the tax rules in detail, explain everything you need to know for your 25 and your 2026 taxes. And AI members, I will tell you, we've reformatted the tax guide this year online. So if you go online, you'll notice we've reformatted it in a way that I think you'll find makes it easier to find key information. And again, we provide valuable information. We cover tax rates, we cover deductions, we explain the tax rules that can apply to most individual taxpayers. And by the way, since I'm showing here the 401k catch-up numbers, keep in mind, those of you with wages of $150,000 or more at your FICA wages, so look at your W-2, starting next year, you'll only be allowed to make catch-up contributions if you're age 50 or older on a Roth basis. So, and if your 401k provider or 403 provider doesn't provide a Roth account, my understanding is you're not going to be able to make a catch-up contribution at all. So you want to talk to your human resources people and your 401k provider to find exactly how this is going to work, because this is a new rule that is going to affect next year. And finally, speaking about tax planning, I do want to show you this tax forecasting worksheet. We have this online on our website. You can download it. It's a simple worksheet that allows you to actually help you estimate what's your tax liability this year and what's your tax liability next year. So we have about 6 weeks left here in 2025. So you still have time to make tax moves this year that can affect what you owe this year, what you may owe next year, and also if you're claiming Medicare, what your tax premium, what you're actually going to pay in Medicare premiums starting in 2027, which will be based on your 25 taxes, or in 2028, which will be based on your 2026 taxes, because Medicare always looks 2 years back. So you do want to consider doing tax planning, what your liability will be this year and what your liability will be next year. So I am now going to turn it over to Christine, and Christine, I'll let you talk about the RMDs and the Roth IRA conversions.
Thanks, Charles. All right, let's get this going here. Give me just a moment and we'll set this up. There we go. And now this always happens to me. All right. Good evening, everyone. It's lovely to be with you this holiday weekend. Hope you're getting your turkey and dressing ready. I'm going to go into a little bit more detail on a couple of things that Charles has explained already. Just want to remind you, I am a CFP but I am not giving you tax or financial planning advice. This is educational purposes only. I am not a CPA. So Charles did a beautiful job sharing pertinent aspects of the July 4th, 2025 tax bill, commonly called the OBBBA, though that is not its title. My goal is to put a couple of the tax changes into sample clients. We're going to look at two fictitious families as examples. One will use the QCD or Qualified Charitable Distribution rule to lower their taxes, and the other will delve into Roth conversions. All these tax ideas interact with other parts of your total tax burden and your annual decisions. So you have to look at this every year. Consequently, prior to December, hopefully October, maybe November, but for sure, now you have time to make adjustments in the strategies that you employ to use these. I suggest you consult with your CPA and your financial advisor prior to taking any of these actions. First, let's look at some ground rules about QCDs. The check must be made out to an IRS-approved 501c3 charity. You cannot receive any benefits from your donation. For instance, if you go to a fundraising dinner where you buy a ticket, make sure you pay for the tickets separately from the donation. For some of you business owners, a QCD cannot be a distribution from a SEP or a simple IRA. You also cannot make a QCD from a 401k. You can, however, make a QCD from an inherited IRA if you are over 70 1/2. That 70 1/2 is a hard stop with the IRS. This does not work if you are not 70 1/2. The QCD will count as all or part of your RMD up to the annual limit. This year, that annual limit is $108,000 per person. In exchange for counting the QCD as part of your RMD, you cannot deduct it on your taxes as charity. But most people use the standard deduction anyway. Often we do this in alternating years when we're gifting from taxable accounts and we're bunching donations and things that we can deduct, like Charles said. QCDs will also avoid the 60% limit of AGI on deductions that you make for cash charitable contributions. This year is a prime time to make charitable donations, since that AGI floor that Charles mentioned, that 0.5%, starts in 2026, but a QCD will avoid that 0.5% exclusion entirely. Since the QCD is not counted as ordinary income, you may find other parts of your tax bill return also benefit. For instance, you avoids the phase out on that senior bonus deduction, since it's not included in MAGI. It's subject to the it's not subject to the income phase out that starts at the $75,000 for singles and $150,000 for married filing jointly. It avoids the SALT deduction phase out from 2025 to 2029. It may even lower your taxable Social Security or allow more of your itemized medical expenses to be deducted. Other phase outs that you might avoid include anything in the MAGI, the ability to currently deduct passive rental real estate losses, taking education tax credits, the ability to deduct college loan interest expense, the ability to claim the new deduction for car loans, the ability to claim the deduction for qualified business income, or QBI, for instance. And you also might avoid IRMA Medicare surcharges if you take the QCD rather than making your charity out of your cash flow. You also might avoid the 3.8% net investment income tax, or the NIIT. All right, so long and short of the QCD, there's one key takeaway here. It's an easy one. If you are charitably inclined already, use QCDs once you're 70 1/2. For seniors, anything that increases your ordinary income, such as an RMD, will have a cascading effect on other areas of your tax burden. Often the question becomes, would you rather write your check, send your money to the IRS, or would you rather send it to charity? Your CFP can help you set up your QCD. Your custodian can send the check directly, or you can write the checks yourself. Make the QCDs first before you withdraw the rest of your RMD. So that's a brief overview of the particulars of QCDs. Now we're going to move to looking at the Roth conversion rules. First, a little review. Beneficiaries lost a lot of the stretch benefit that came with inheriting an IRA when Secure Act 1 was implemented in January of 2020. That limited beneficiaries to 10 years of drawdown for those inherited IRAs. Secure Act 2 then cleared up a lot of the confusion about those rules in January of 2023. And finally, the Tax Act in 2025 locked those tax brackets at the current percentages, giving us all about a 2% reduction in our taxes versus what was scheduled to start in January of next year. We Americans love to complain about how much we pay in taxes. However, the current rates are historically quite low. At least until the next Congress is seated, we can plan on doing these things. So let's take advantage of the current low rates to make a Roth conversion while we can. So what are some of the rules about the Roth conversions? First, there is no income limit on a Roth conversion. There is on a contribution, but not on a conversion. The conversion amount will be taxed at your ordinary income rate, and thus it may kick you into a higher tax bracket. Higher income has other tax consequences as well, so you have to analyze your own tax strategy carefully. There are two reasons to consider doing a Roth conversion. First is that you want to lower your lifetime tax burden. Even if you pay more tax this year, you might do that because you expect tax rates to rise in the future, or you anticipate being in a higher tax bracket due to the size of your RMDs. The second reason to consider a Roth conversion is as a gift to your heirs. Since Roth accounts do not have to pay taxes, if you convert some or all of your tax-deferred retirement accounts to tax-free Roths, your heirs will not have to pay tax on those accounts. So we're encouraging you to think long-term, big picture, lowest lifetime rates in your analysis. Let tax planning, not tax burden this year, drive your decision. So here's where I'm coming from when discussing tax brackets with clients. They often balk at paying additional tax because we're suggesting a Roth conversion that may even put them into a higher tax bracket. When most of attendees tonight were born, probably in 1940s, 1950s, the tax rate was 91%, and it stayed at or above 50% until 1987. What do you think Congress will do to tax rates in the future, whether it's 2 years from now or 22 years from now? I don't have a crystal ball, but I think I can make an educated guess. So we're going to consider two couples. Dr. and Mrs. Professor are ready to retire. Mr. and Mrs. Jones have a longer runway. Both couples are fictitious, but I'm going to walk them through some Roth conversion planning. I don't have time to delve deeply into this couple's tax return, but to do this type of analysis, you have to share your entire tax returns with your advisor along with all the other requested information. So the professors are currently in the 22% bracket. Let's see what might happen if they fill up the 22% bracket with Roth conversions starting this year. Peter will retire at 73, Paula at 70. Peter is just now over 70 and 1/2. So he can do QCDs. So here are the assumptions that we made for their overall strategy. They want to convert almost all of their IRAs to Roth. So their tax deferred assets are $4.475 million. They want to do it by filling up the 22% bracket. They are going to combine it now that he is 70 and 1/2 with $50,000 a year QCDs. We assume an 8% conservative rate of return on their portfolio with a 2% average rate of inflation. So that gives them a 6% real rate of return after adjusting for inflation. They will pay tax on their conversions using money from their taxable assets, that's $743,000. Their scenario analysis is one of your handouts. We assume that Peter got a 2% raise in 2025, but we left everything else the same on their scenario in order to simplify our comparison of scenarios tonight. So the first column that you're looking at is the information directly from their 2024 tax return. For the second column, we copied the 2024 return, changed the year, which then changes the tax calculations to reflect the changes in the OBBBA. That is our baseline 2025 scenario. The third column then shows that same scenario plus a $64,100 Roth conversion, which is where we settled to fill up the 22% tax bracket for them in 2025. They have an inherited IRA with a $9,750 in RMDs, and they are happy to learn that they can now do that as QCDs. Here's their Schedule D and Schedule 1 income information. Note in the middle column, which is our base case, it reflects Peter's raise, and the third column shows that 64,000 Roth conversion. So their adjusted income for 2025, if they do this Roth conversion, is now going to be $297,493. So how bad is the tax hit for 2025? Well, the 64,000 conversion raises their effective tax rate just 2%, from 17.1 to 19%. They will lose their OBBBA child care partial deduction, but it was only going to be $996. The conversion, we estimate, will cost them $16,126 in additional federal tax, which is 25.2% on that $64,000. Well, now what? Their first reaction talking to me is, are you crazy? You want us to pay $16,000 more dollars? You want us to pay $55,723 on this year in taxes, including our FICA? But I show them what they can accomplish over their lifetimes by using this Roth conversion strategy that focuses on filling up the 22% bracket. So my goal was to keep them into the 22% bracket as long as possible in this example. The decision on where to land depends on your excess money or your taxable funds to pay the tax and your unique goals. You may not have charitable goals. You may not have a legacy goal and wish to leave any money to your heirs. So this may not interest you at all, except that it would lower your lifetime taxes. Keep in mind that there is no minimum or maximum allowed conversion amount. Just because I used 64,000 here doesn't mean you can't do a $5,000 conversion or a $5 million conversion if you have the money to pay the tax. In fact, I have a client doing a large conversion this year while offsetting some of the tax by maxing out a QCD to a donor designated fund with their local community foundation and a donor advised fund using their taxable highly appreciated stock. I will tell you, if you have $1 million or more valued IRA, you should consider a multi-pronged strategy, such as combining with some sort of charitable fund for your concentrated stock position, gifting, tax bunching in alternating years. It will get much harder to make a conversion work for large IRAs because you're already going to be in a high tax bracket. It can be done. But let's go back to the professor family. Jumping to the end result here after our conversation, they indeed save tax money over time. The dark line shows the increase in the taxes while we're doing the conversion. So they're actually paying more tax at first. But in 2037, things begin to shift dramatically. At least one of them needs to live that long in order to tip the total tax in their favor. It is an impressive difference in lifetime taxes, and it will still work if one of them dies prior to 2037, just not as dramatically. But we are estimating, based on their value of their accounts, a total lifetime tax of over $5 million between now and when they pass at 95, versus what we might have for them at around $3 million if we do the Roth conversions. That is a huge difference. It is worth looking into. So as we discussed earlier, financial planning strategies have a lot of balls in the air. You toss one idea up and then you need to look at what happens to all the other areas. For instance, by doing the conversions, we push them into a higher Medicare IRMA surcharge bracket. In my mind, anything that is an additional amount of money that goes to the government is a tax. So they are going to have a lifetime drag of $36,400 in extra IRMA surcharge. But when you compare that $36,000 to what we project they will save on their income tax, this is just a pittance. Lowering RMDs by converting IRAs to Roths, paying taxes at your lowest lifetime rate, and rather than focusing on the lowest rate this year, and avoiding unwanted RMDs later in life when that traditional IRA retirement account has gotten larger, has a tremendous effect on your total portfolio value. Even if we shorten their life from 95 to 85, it still has a beneficial effect. The other shocking thing for retirees, especially BI and AAII members that usually have larger retirement accounts than your friends and neighbors, is the size of their RMDs as they age and their accounts continue to grow. If you just take the RMD out of your retirement account each year, you have a 96% chance of your retirement accounts being larger when you die than they were when you started taking your RMDs. But let's move, so you can potentially his RMD when he is 80 years old is going to be enormous compared to what it would be if we do the Roth conversions. And that's only filling up the 22% bracket for them. But let's move on to the pre-retiree couple and ask ourselves the question, is it worth doing Roth conversions despite having wages currently. I thought I was supposed to try to decrease my income when I'm in a higher tax bracket. So let's look at the Jones family. They are looking to retire soon, but they are in their high income years. Sarah plans to retire maybe in 2027. Mike in 2029. We examined several scenarios. They chose the one with the lowest lifetime tax rate. In their case, that means we focus on filling up the 32% tax bracket each year. They could have chosen a strategy that leaves the largest legacy. Sometimes the two strategies are identical, but not always. They are going to front load their Roth conversions to take them before they reach RMD age. So here's a breakdown of their investment assets. They have $1.9 million currently. They have a legacy goal. They want to leave $200,000 in today's dollars to their kids if they can. And their house is valued at $500,000. It is not included as a part of retirement assets. So the most common withdrawal strategy used by retirees is to let their retirement accounts grow for as long as possible. That is what we call a taxable, tax-deferred, tax-free strategy. That means they spend their savings and their taxable brokerage accounts first, and then they spend their tax-deferred retirement accounts when RMDs kick in or they run out of taxable accounts. And then when all of those are gone, they spend their Roth accounts and their HSAs. Unfortunately, the result often has painful tax results, as we saw with the previous couple, because they reach such high RMDs. This is especially true if we assume tax rates will rise in the future, or if you have legacy goals. So the analysis I'm using here uses a different app just to give you a different view of how your analysis might work. This shows that the Joneses will significantly lower their lifetime average tax rate, saving an estimated $1.4 million in taxes. Their average tax bracket using the traditional would be 16%, and with the Roth conversions to the 32% bracket, we're going to lower their average tax rate down to 9%. A serendipitous surprise is the increase in the legacy that they have potentially to leave to their children. That gives them a lot of leeway to consider charitable strategies that they've always wanted to do. We also have not included charitable giving using QCDs in this example. The end result is that even higher tax brackets can work with Roth conversions. They just have to bite the bullet and pay the taxes now. This has been a whirlwind demonstration about how current tax rates may give you at least a few years until Congress changes the law again to do some proactive strategies to lower your tax burden and help your favorite charities at the same time. So the Joneses, since they want to front load their conversions and fill up the 32% bracket, take huge tax hits once they retire starting in 2027. They only last for 6 years. Then their federal tax goes from about $60,000 in 2026 to $150,000 while they are doing these conversions. Then it drops to almost nothing for the rest of their lives because they've converted everything to Roth IRAs, which are not taxable. Even their Social Security benefit may not be taxable going forward. Plus, their children may actually inherit their Roth IRAs, which have no tax burden. Now, remember, they are also going to pay a high Medicare IRMA each year that they make those conversions, and those IRMA surcharges will last for 2 years after the last large conversion in 2030. Their goal, however, was to get all this done before their RMDs kicked in, and we have accomplished that. In both of these examples, these couples had a wide range of scenarios to consider. This is not an all or nothing. You don't have to fill up a tax bracket. You can look at an IRMA bracket. You can look at a dollar amount. They will confer with their advisor and their CPA. They will probably do better by also making quarterly tax payments while they're doing these conversions so that they don't have IRS interest tacked on. These two strategies are the most common conversations I have with clients as we get this close to the end of the year and they're doing their tax planning. Since those over 65, like Charles said, are eligible for enhanced senior deductions for the next few years, it gives us a little bit of leeway on the amount of conversions that we can consider. We just fill up enough to not get that enhanced senior deduction. Don't wait to talk to your advisor about this. Time is running out. Their clients are all calling. Your CPA is busy right now, especially if you're going to pair these with charitable giving and you need to get with your local community foundation. Thanks so much for your time. It has been a pleasure to be with you this evening. I wish you all a wonderful Thanksgiving holiday. And if we don't get around to your questions, feel free to contact me. I'm busy, so I might not answer you just right off. Just want you to know. All right, Jenna, there you go.
I appreciate it so much, Christy. Thank you. Your presentation was fantastic. We've been getting a lot of questions coming in. So I know we're running a little bit over time already, but there's just so many different things to address when it comes to taxes. So I know a lot of people have good questions. As Christy said, if we don't get to your question during our live Q&A, you can email her directly, or you can email us at members@AAII.com, and we'll be happy to get back to you as soon as we can. All right, let's see. Got a lot, so let me go through these a little bit. I think I'm going to start with Christy. You first, just because your presentation is right on the top of everyone's mind. Let's see. Does the new itemized deduction limitation apply to all taxpayers or only to those in the 37% tax bracket?
No, it applies to all taxpayers. That 0.5% that we're talking about, yes.
Okay, excellent. And I saw a couple different questions come in. So can donations made to a church or other religious organization qualify as QCDs?
As long as they are a registered 501c3, yes.
Excellent. And let's see. If someone inherited an IRA and started RMDs before the 10-year rule was introduced, does the 10-year rule still apply?
No, if the person decedent died before 2020, they are on the old schedule, which is connected to their lifespan, not to the 10-year rule. Okay.
Let's see. Let's see if I can find another one. Is it true that if you only convert part of your IRA, the taxes become higher because of all of the other IRA balances are included in the pro rata calculation?
So if you have maybe Charles should answer this. If you have put in non-tax or after-tax donations to your IRA, then you're going to have to do a pro rata calculation. But if you're just making, if you haven't done any, am I getting that right, Charles?
Yeah, well, I'd say if you think you might have IRA contributions that may not qualify, may not be qualified, meaning you're not able to take the deduction, put in a separate account. And to give people an example, when my mother-in-law is alive, she had a trust, and I didn't, and obviously We wanted to live as long as possible. We didn't know what the timing was. So every year, I set up a separate IRA account. It took a couple minutes of filling out paperwork, but this way, if something, had she passed during one of those years, and we did get hit in a higher income bracket where those contributions would no longer be qualified, that account was separated from all the other IRAs, and that way they weren't commingled. So that's the big thing, is you don't want to commingle funds that you took the tax deduction on with contributions you weren't able to deduct. Because as Chrissy's alluding to, you end up with a big tax headache, and you trust me, you don't want to deal with it.
Okay. Let's see. Oh, this is a good one. Can a QCD be larger than someone's required a minimum distribution?
Oh, absolutely. Up to the maximum, which is 108,000 this year. Yeah.
Okay. Excellent. Let's see. Now I have one more. So for Roth conversions after your age is 70 and a half, do you have to take and pay taxes on the first RMD before converting any additional IRA funds to a Roth IRA?
I'm not sure I understand the question. Anything that comes out of an IRA, whether it's conversion or it comes out as ordinary income, except a QCD. So if you want to make QCDs, you do those first, and then you take the rest of your RMD. So if you have a $50,000 RMD and you want to give $5,000 to charity, give the $5,000 first, and then take the $45,000 out as your RMD.
That makes sense.
Okay.
Listen to Christy on that one. Trust me.
Let's see. Okay, and then I have a couple that were specifically for Charles as well. I want to get through a couple of these as well. Some of them kind of go back a little bit when you first started the presentation. So let me get those first. Let's see. Okay, so will Roth conversions receive any preferential tax treatment in 2026?
No, the laws are saying exactly the same. The only advantage you have in doing 2026 is you do have this new deduction. So if you're a senior, you get the enhanced deduction. If you have a car, you bought a car next year, you get that deduction off your interest. You obviously still have a car payment, but you do have those new deductions. But there's no other. Otherwise, the laws for the IRAs are the same as they were this year, with the exception, of course, of the 401k, and that's actually a Secure Act 2.0, where you now have to make the Roth IRA contribution if your FICA income's above $150,000 or more.
Okay. And then, is it wise to make a donor-advised stock donation before the end of 2025 to secure the current tax benefits?
That actually is not affected by it. It's really just as your chair. Well, actually, it is, because you do run into Christy. I think they would run that case into that floor, wouldn't they? That 0.5% floor with the.
Yep.
So yes.
And then a couple of questions came in on when you were talking about the SALT deductions. Can someone prepay next year's real estate taxes to increase their SALT deduction for this year under the current rules?
They can pay the tax that is actually for this specific year beforehand. So anything, same thing, your mortgage interest. If it's due this year, you can pay it this year. But if it's due January 2nd, you can't pay on December 31st and claim it as a 2025 write-off. It's actually tax was due in 2026. So that's your deciding factor. We talk about that in a tax guide. So it is, when is it actually, what year is that tax actually for, and when is it actually owed?
Okay. And then just to clarify, since we're talking about SALT as well, do SALT deductions include state and local property taxes?
Yes.
Okay, perfect. Had a couple of those come in, so I just want to make sure it's clear. As far as you mentioned the auto loan interest, does the auto loan interest deduction apply to loans already in place or only to loans originated in 2025?
It has to be originated in 2025 through 2028. If you took it in 2024, there's no deduction.
Okay. Let's see. We had a good question. This could be either one. Christy or Charles can take this one. What is the biggest mistake you've seen investors make when it comes to QCDs, especially with when they update the rules?
make mistakes with QCDs. Well, I would say, first of all, they are used to writing the check out of their checkbook, and they just keep writing the check out, or it's an automatic, draft from their bank account. And they never bother to, once they hit 70 and a half, stop all that and go to writing it out of the IRA. So just postponing what is there when they are 70 and a half, I think, is the biggest mistake.
Let's see if I can find any other ones. There's a lot of questions coming in, so I think we're not going to be able to get to all of them. I'm going to probably just choose one more, and then we'll wrap the Q&A. But like I said, if we missed your question, please feel free to email us at members@aaii.com. Let's see. I guess this is more of a general question, but is there a limit on how many times you can convert money from a traditional IRA or 457B to a Roth IRA?
No, you can do it when you're 95 if you want to.
Okay, excellent. All right, well, I think, there's still a lot coming in, but yeah, like I said, please feel free to message us. We'll be happy to get back to you and answer your questions. I know taxes can be very overwhelming, so we're happy to help any way that we can. But I want to thank, Christy and Charles for both of your presentations. Before we wrap up and share some information about the recording, email, handouts, special offers, I'd like to give both of you a few minutes for some closing thoughts. Charles, if you want to kind of kick us off, and then Christy can follow.
Sure. Something that's very simple. If you're married or you have a partner, have them look at your tax return before you file it. Give them every form you have. I do with my wife every year. She rolls her eyes, but the big reason is they might catch something that you messed up, and if you transpose a number, if it's small, the IRS will just send you a letter saying, hey, we fixed this. But it keeps the IRS off your back if you have someone else that particularly if you're married, have them look at it. The other reason is if you are married, your spouse should know what's in your tax return. But the big thing is to have them catch any mistakes you might want to make. You don't want a small mistake turning into a big headache.
That's good advice.
Well, I guess I would say make sure that you would rather pay taxes to the federal government versus paying them to a charity, because in many ways that's the decision you're making. We did not delve into the difficulty of the pricing of Affordable Care Act healthcare plans if you are not on an employer plan or on Medicare, that all of this would maybe go out the window or have to be altered because of the premiums on that, because those are all in flux right now. So you throw one thing up in the air and everything else blows up too that you gotta consider.
That makes sense. And again, thank you both so much for your time and your presentations. I know we had a lot of great, a lot of attendees tonight. I know they were very excited to hear about tax strategies for 2025 and 2026. So I appreciate your time and being able to go through all the information. If you have any questions about AAII's tools or services, feel free to email us at members@aaii.com, or you can give us a call at 312-676-4307. That's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then if you have specific questions, tax questions for Charles, you can also email him at charles@aaii.com. And then on the flip side, if you have any questions for Better Investing, please direct your questions to service@betterinvesting.org, or you can call them at 877-275-6242. And then now, I know I mentioned that we have exclusive attendee offers. So new subscribers can join AAII Plus for just $97, regularly priced $199. And as a bonus, you'll also get access to member benefits like the AAI Journal, Model Shadow Stock Portfolio, investor guides like our tax guide that we're releasing December 1st, 2025. You'll get access to stock screens, stock grades, and so much more. So all you have to visit is AAII.com/betterinvesting. And for AAII members, Better Investing is also extending a special offer where you can join Better Investing as a Plus member for only $99 for the first year. That's regularly priced $145. And then all you have to do is use the promo code AAII at checkout to save. And both of those offers are accessible in the handout section. And then we'll also include them in the email that we send to attendees later this week. And then, like I said, this is our final AAII and Better Investing webinar of the year, but we plan to hopefully resume in 2026. So dates will be announced later this year, early next year, so keep an eye out on your email. And then we'll also hopefully be sending a survey to all attendees to gather some input on the topics that you like to see featured in 2026, and then what you liked about our partnership series in 2025. So yeah, like I said, please keep an eye on your inbox. We would love your input. And lastly, this presentation was recorded and a replay will be available at AAII.com/webinars later this week. It'll also be available on our YouTube. Webinar attendees will also receive an email with the link and other helpful resources in the next few days.